All right. Last thing we're going to do here today, actually, is we are going to move into the Queen's Court. And the Queen's Court has been something we've had a lot of fun with, and we've been doing now for 3 or 4 months, I believe. You know, we come in each and every week. The coaches bring stocks or analysis for the Queen. The Queen has decided to go in a different direction today, and she found 2 different candidates to actually share with us. Matt, kind of set this up a little bit. It's going to be a new concept, new way we're going to do this today.
Well, in the Queen's Court, what we're going to try today, and I like it, is the Queen is going to present her ideas to the court. We, the coaches, Mark, myself, and Tim, we are the Queen's Court. We are going to advise the Queen on which one we prefer, and then the Queen will subjectively kill Tim.
Oh, touche. That's funny.
Did I do okay?
You did great. You did great.
Okay.
Let's roll. Let's do it.
Wonderful job of explaining that.
Thank you.
Okay, so you guys know that I like to keep things simple. You guys know me personally. You know my life. You know I'm busy. I've got kids. I'm running around. Most of the time we're doing coaching sessions. We're teaching labs. We're here on the halftime report. I like to keep my portfolio very basic and very simple and very easy. So without even having to talk about all the different sectors, you guys already know where my eye is this week in terms of which sectors I'm looking at. It's the 2 that are the best performing, financials and energy, right? So if I'm just going through my process of elimination on how I approach my week, that is where my main focus will be. It's going to be something in the financial or something in the financials or something in energy. Why? Because I like the pattern. I like the trend. I like the levels. They're easy to identify. You can break out, a level really, really easily on financials. We talked about this last week, right? So rather than focus on something in financials, because we did talk about this last week on Queen's Court, we're going to go look at the other sector that is performing well in the energy sector. So with energy, just like financials, we do have earnings coming up. But I still like this area of the market, and I'm still going to find something that I can cash flow on. So my approach this week is doing a naked put, but I need you guys to help me decide. Either we can go and play the equity itself. I'm looking at a couple of different ones, and I think I'm down to DVN, but we can look at a few of them and kind of analyze them, or the ETF itself. So if we kind of go through, we had I believe we had APA on the options report this week, if I'm not wrong. That was one that we had on the options report this week. We also had DVN. So between APA and DVN, I'm looking at doing a possible, I'm looking at doing a naked put on DVN and compare that naked put to the ETF itself, XLE. Okay, so DVN, if we look at DVN, I obviously love the pattern, right? So first of all, what is the naked put? What bias are you supposed to have on a naked put? Well, if we look at our rules, if we understand what a naked put is, you want to have a bias of where you're somewhere between neutral to bullish, right? So anywhere between a 0 to a +2, right? So if you have that bias and you're looking at the chart and you see that, you're like, okay, I like DVN for a naked put, right? And then what type of strategy is it? Well, it's a cash flow strategy. You guys know me. You know I like to get paid. I don't like spending money. I like to receive money. There's my other checkpoint, right? And then you look in terms of the fundamentals. Well, it's the energy sector. What has oil, what has the energy sector been doing? What's, crude oil been doing over the last few weeks, right? So those just check the box for me. So it makes it a very, very easy decision in terms of what I'm going to do. So now when I go out to the options chain, and look at that, I'm going to start looking at my rules, right? What rules are we going to apply to this naked put? Well, we want to be around 60 days or less. So I'm automatically looking at that November 19th. Tim, quick question. When is my birthday?
Happens to be November 19th.
Okay, there you go.
Yes, that's exactly right. I learned this last week on Queen's Court.
Really hoping that he forgot.
No, I got chopped last week because of that. So I'm looking at the November 19th, and I'm using my delta rules, right? So I'm looking at somewhere between a 10 delta or anywhere between a 25 to a 10 delta. I'm looking at that 11 delta there on that 31 strike mat.
And so if we look at that, we're going to receive around 43 cents on that. And you guys can run we'll use a spreadsheet to run the ROI, but that's kind of like where my basis point is starting at, right? I'm looking at that 31. And then if we throw that on the chart and look at where it falls under the support levels, am I underneath those levels of support? Am I comfortable taking ownership if it was to be assigned to me at that level? And once I look at that, I look at the distance between where the price of the stock currently is relative to where I will take ownership should I be assigned that stock. And then I'm going to look at the ROI and measure that as well. And if all those three boxes check, then it is a go for me. So that is my first option there with DVN, is doing a naked put 31 strike on DVN. So now let's compare that with the ETF itself. And we'll look at XLE. So again, DVN is in the energy sector, so kind of same analysis in terms of the fundamentals and all that stuff. So this one here is just a matter of where am I going to sell that naked put. And on DVN, I am looking at that 51 strike. So if you take me back to the options chain, and again, just
on XLE, not DVN.
I'm sorry, on XLE. 31.51. Okay, so yeah, 51 on XLE, same November expiration. So now we're looking at the 51, picking up about 64, 65 cents on an 18 delta. The reason, well, I'll tell you guys which one I'm leaning towards after you guys tell me, but obviously one's because, we've got earnings coming up ahead with DVN. We've got that earnings coming up real soon. With the ETF, we don't have to worry about earnings, right? Kind of like the reason why we did XLF last week on Queen's Court. So that's kind of like my reasoning behind it. What do you gentlemen think?
On the 51 strike price?
Mm-hmm.
When it comes to a naked put, I guess the question for me, Queen, is, are you looking to cash flow or are you looking for ownership? Mm-hmm. Because a lot of times, you take Coach Gino, for example, 99% of the time, Gino's just stacking theta. He doesn't care about anything. Like ownership, I don't want to own anything. I just want to control everything. That's Gino's philosophy, right? And so he's just one of those traders that I call that likes to stack theta, right? They want to identify where this is never going, and so I never have to think about it, and I can just collect my cash flow, right? So the question I have for you is, because if you're looking to own versus looking to not own or stack theta, the level I would recommend selling would be different. If you're looking to own, I would say you want to sell slightly above support, known where you identify as known support. Mm-hmm. Yeah. If you are not looking to own, you want to sell underneath support to allow support to work for you. And so are you looking to own or are you looking to stack theta here?
For both of these, we are looking to just straight up cash flow and get that theta in.
So we're just looking to stack theta. Correct. And so I would say selling the 50 strike on energy would allow 50 to 51, which is a very well-known historical support level, right? Mm-hmm. A very well-known. You're talking about that 50, right? You're looking at that little resistance level. You'll allow that to work for you. If you're looking to, and honestly, if you're looking to never even look at it, I'd say coming back to the option chain.
Yeah, what is the difference?
Maybe even sell the 49 here.
Yeah.
And so I would say if you're looking for ownership, I would say the 51 strike. If you're looking for just simple cash flow and stacking theta, I would revert to either at support, i.e. 50, or slightly under support, i.e. 49. So it really just depends. Now, obviously, looking to own would be the 18 delta. Looking to not own would most likely be the 14 or the 11 delta. It just really kind of depends how much range you want to give it, quite frankly.
Mm-hmm.
Yep, and that's why we have those ranges, right? You have a delta between 10 and 25. You kind of go through and run your numbers. And actually, why don't we do that? Why don't we?
Yeah, I want to know the ATR buffer. I'm very curious about this one.
That's
well, the ATR buffer on energy is basically per strike price is basically going to be about 1.
Mhm.
So if you sell the 50, you're going to have right around a
4 or 5 ATR
about
buffer.
4 or 5. If you sell the 49, you're going to have somewhere around 4.5, 5.5. I'll fill them out, but either one, you have the range.
Gotcha. Those are
The
good.
range is not concerning to me here. We're not dealing with something with an implied volatility ranking of 80, right? Those are when ranges become really, really important. When you're dealing with an ETF like XLE and a beta of slightly +1, ranges typically aren't going to be that concerning. And so I will say that you're good either way, honestly. It's really, Queen, just about how much do you want support to work for you, hypothetically. I think this is a very small matter, by the way.
Right.
On XLE, not
Mhm.
a small matter in general.
Mhm.
On XLE, I think, and by the way, if you sell the 49 versus 50, I'd probably sell the 50 here.
I think
If it
so.
goes under 50, I think it's going to go to 49, and I think it's going to go to 45. So I think 50 is the level you're fighting for here.
Gotcha. Anything else on the analysis, Em, before we give you all of our feedback here?
No, that's why you guys are here. You're on
Well-
my course. You can give me your feedback.
Yeah. Matt, you first. What are you thinking?
Well, I guess all the feedback on what? Because I thought we were just discussing
I thought
what
Matt
support
just
level
gave
is
his
short.
feedback.
Yeah.
For me, I'm looking at both of these, and this is the
Oh.
first time we're doing it, so I'm just trying to
Hold on.
Yeah,
We haven't even filled out the numbers yet.
I want to see those ATR
Yeah.
buffers for sure. You want to do that next? Numbers?
Well, again, I need to hear from Emily or from the Queen specifically which one you want to sell so I can fill out the numbers.
Okay, so let me look at that chain one more time. I think I'll probably go with the 50.
I think 50.
Makes sense.
And again, you're getting 10 more cents on the credit, which will matter here. You're getting 10 more cents on the credit. But again, my philosophical viewpoint is if it breaks 50, it's going to 49 anyways.
Exactly.
Right. And that's kind of what I feel here. And so I think you take the 10 cents and you sell the 3 delta points higher and you're fine. You're fine. So when we come to XLE and you're looking at the spreadsheet, and I'll fill this out for my Queen. So basically what we do, guys, is we just fill out the spreadsheet. So on XLE, obviously the symbol is XLE. The price of the ETF is $56.24. The ATR of the ETF is $1.37. Now you can fill out the month, November. I usually don't, because the only thing that the spreadsheet really matters is the days till expiration, and that's 38 days till expiration. The strike price is the strike price you are selling, because that is the one that you are concerned about. In this example, that's the $50 strike price. That delta had a delta of, I believe it was 14.
On XLE, 50 strike, 14.
Yeah, it was 14. Now, net credit, if you don't know how to calculate it yourself, net credit, you can simply right click, go to sell, single, and you can simulate the trade and it will tell you what your net credit is. Now, typically that's going to be around 10% of the strike price you sell, right? So if I sell at $50 strike price, that's going to be $500 per contract. Typically it will adjust based on volatility, but you get the general rule of thumb here. And so I need to put up $500 in cash flow that's not my net credit. I need to put up $500 in cash flow, and I'm going to get
49, I believe.
I think it was $49 in cash flow here. And so let's do $49 in cash flow. Now, as you can see, what you will see here is you'll basically see what your numbers are. You have a 9.8% projected ROI, and that's based on the 38-day number. You're getting 7.7% on the actual 30-day number, and that's probably the more important number here is 7.7%. The standard ROID on the naked put right here is 55. Anything over 50 is good. Remember, ROID calculates ROI divided by delta, but the metrics on performance is subjective based on our tackle trading research. And so basically how I did the ranges on what is good and what is bad is I basically did this a million times. And I might be exaggerating a little bit, Tim,
Not that far
but
off.
it's just a little bit.
There's a lot of numbers we've run.
Just a little bit.
Mm-hmm.
And so I'm not going to get into that because that's internal tackle trading stuff. But again, over 50, that is good. And so again, we're getting a fairly decent naked put here. And again, this is for stacking theta. I don't want ownership. I just want theta. That's what your numbers do represent.
Yeah,
now,
very good.
On DVN, Devon here, DVN. Now, this is the individual component of the stock or of the sector. You're talking about $39. The ATR was $1.64. Month we're working in is November again. We're also 38 days to expiration. Now, am on DVN here. Let's go back to DVN. Let's go back to DVN here. Now on DVN, if we take conceptually the same concept we just talked about on energy, just to make apples to apples type comparisons, and what I would suggest is we identify where that support level is. Let's make sure, again, we're just stacking theta, right? That's all you're trying to accomplish here is just Geno stacking theta. And so here, we're obviously a little overextended. Obviously, I expect a little bit of dip over time, but again, we're selling very, very deep here. I'm going to identify that 32 level here. Little 32, you do have some support here around 30 and a half, but I'm going to identify that 32 level. We want to stay underneath 32 here. Okay. And so and again, kind of the step-by-step process we're going through, Team Tackle. Emily identified a stock in an industry she has interest in. We then looked at the technical scenarios to identify where those key levels are. After we discussed, are we cash flowing or are we looking to right to own? Once Emily said, we're just cash flowing, we identify the major support level and we want to sell that naked put right underneath that support level so support works for you. You don't want your strike price being hit here. And again, if your strike price gets hit, guys, the trade management's simple. It's get out.
Yeah, you're going to have to take a loss.
There's not a discussion. There's not a debate. You take the L. That's the conversation. That's why you identified support. If it breaks support and thus hit your strike, there's no, well, maybe it comes back up. You're right. If you ask any coach and you said, well, it might come back up, they would say, yeah, it might.
Yeah, you know what? I thought I was going to win this week for my fantasy football. I'm still 0-5. You may not. Take the L. Just take it.
Take the L. Take the L.
That's right.
So,
Emily, support is broken on your fantasy football team.
No, it never formed.
There is
no pivot to pivot confirmation at this point. Emily's fantasy team is like Comcast right now. It's just free fall. Okay. Queen, I say that with respect.
If he doesn't get his head chopped off,
I'm not. I'm the one. Listen.
Tim is definitely getting.
I'm going to find a way.
Yeah,
I'm going to find a way.
You already did. There's nothing you have to do. Okay, but again, I'm your court, right? I'm trying to help here, trying to help the queen make some decisions. I like 32 here. All right. So 32 is the level we want to sell underneath. So we come to 31. 31 is that 10 delta strike price. All right. You can certainly go underneath that. You can certainly even sell that for, but you're going to, for the higher probability, you don't get much but chump change.
Yeah,
right?
exactly. 31 is good. I was looking at 31. 31 is good.
Mark can go to McDonald's one time per contract at that level. He might not want that. He might want a little bit more. So
yeah,
I think
he can stick the inflation is transitory up his ass because if you look at McDonald's prices lately.
Yeah. He's mad at McDonald's.
He's mad at the McRib price.
Guys, that was not sarcasm. That was some real pain. That was some real pain right there. Like, have you seen the dollar menu at McDonald's? It's not $1 anymore. He does the Dollar Tree at McDonald's stuff. Okay, Queen. They're trying to get me off my game. I'm on my game. 32. I don't think we need to go deeper out because once again, 32 gets violated. Think about the level of things that have to transpire for this to get violated. The entire energy sector has to turn around.
Mm-hmm.
The entire energy sector not only has to turn around, but it has to give up every gain it's made in the last 3 weeks. And I just don't see that as probable, right? The market's defining it at about 10%. I like our side of the equation there. And so we're going to go and I'm going to recommend selling that 31 to the queen. Okay. Now, let's go fill out some numbers here. We don't need disclaimer. Let's go fill out some numbers. So the strike price we're selling here is the 31 strike price. It had a delta of 0.10. The Atr buffer is 4.9. The standard's 3.9. Now the net credit, how we do that is we just go to sell that contract, slap that into the mid per contract. 310 again. You're seeing a little 10% of margin here, 31 strike, right? So 310 per contract. We're going to get $42 on the credit. So we're going to get $42 on the credit. 310 is the buying power. Now, let's look at some numbers here. Okay, you see that number right there, the one in red? That's the alert. Okay, you put an alert on the chart to get alerted to if you need to make a decision, basically, right? So if my spreadsheet tells me I need to put an alert at 5069 on XLE here, let's go to XLE. Then I'm going to right click. I'm going to create an alert at
5069.
5069 at or below. So if I'm ever alerted, I need a decision. Now, typically I'll do if it's to right to own. I don't do that. You're writing to own. You don't care if it goes under, but right to cash flow. You got decisions to make because there are trade management tools. You can roll it down and out. You can roll it down. There are trade management tools. You might just want to get out. You might want to adjust, right? But again, that's more of an advanced concept. I'm just showing people how to do the alert. Now, looking at the numbers here, and I'm just going to go standard ROIs here. On the XLE trade, you're going to get a little bit less credit. You're getting 7.7% versus the 10.7 on DVN, okay? The ATR ranges are very, very similar on the 30-day number, 3.6 versus 3.9. Very, very, very similar. The ROID is fundamentally different, given the fact that we are selling a 10 delta contract on DVN. We're selling a 14 delta contract. So we're selling a 10 delta contract, but we're getting a higher credit with less margin. That's why the numbers look so much better on DVN is, again, you're getting a higher credit, lower delta, less margin. So why am I going to say to my queen, you would rather have the XLE contract though? You would rather do the energy contract because I know Emily. I know the queen. And the queen wants one very simple thing in her life. She wants to live her life by her rules and she doesn't want to deal with the emotional nonsense of things. And so she just wants to stack her theta, get her credit, and go live her life. The DVN trade, it is better from a metrics perspective, but you're going to have more volatility to it. You're going to have more management to it, and you're going to spend more time thinking about it. You just are. And you also have earnings. By going to the XLE, you're mitigating the earnings risk. That's number one. You're mitigating the time you have to allot to management. And this literally is a set it and forget it scenario because you're dealing with an entire sector. My queen, based on all of the discussion, based on the metrics, I would recommend out of these two trades, I would recommend XLE in this time frame, given the fact that DVN is just slightly too volatile in front of some fairly important earnings for DVN. And so if we can remove earnings from the equation and still get a similar ROI, I think that's worth it. I would recommend XLE to the queen.
Thank you. Appreciate that. Mark, I want to hear your opinion. You've been quiet.
Well, I mean, Matt was given a textbook lesson on how to fill out that sheet there that hopefully everyone got a few pointers on. Listen, I think both are winning trades, but I also think that oil is going to maintain the breakout. It's a no-brainer for me, and just to piggyback off of what Matt said, it's XLE all the way for the reasons he just said. The producers, the Devons, the Murphys of the world that have had these big, huge run-ups, right? While I think the breakout is going to hold, that doesn't mean there can't be some volatility, right? And you are going to see if you have a big oil day down, XLE is going to be down on a big oil day. Devon and Murphy Oil, they're going to get killed on that day. Doesn't mean that there's not opportunities ahead, but you're
39 could be 35 fast.
Yeah, really, it's a high volatility stock.
Really, really fast. And I have interest.
Well, what is the exact volatility? 57% on XLE, 34%. Big difference.
And because we didn't, and so because things are prone to volatility. We know that in the oil market for whatever reason. Let's say Biden administration come out and says we're going to do X, Y, Z, even though it's nonsensical from a fundamental standpoint. That don't mean the algos and day traders and everything are going to take that news line and send it down. So there's a lot of things that can set. Let's say there's a new Woo variant or whatever. There's a million things that can impact the oil market in the short term. And if you see any of those days, it is going to create oversized loss days on Murphy Oil, on Devon, and on Marathon Oil, on all of the things that have had the biggest run up. And so just from a management standpoint, now, if you were talking to me about ownership, I'd have a different take on it. I was going to make that point as well. Devon. Yeah. I really like Devon, the company. I like a lot of these producers here. I think especially at lower level naked puts, I think they offer a lot of real genuine value. But the premise was you want theta, easy to manage, not worry about. You just don't want the volatility associated in the next 5.5 weeks from a naked put standpoint. There could be a lot of great trading opportunities in Devon in the coming weeks, in Murphy, in Apache, in Marathon Oil. There'll be a lot of good trading opportunities in the coming week, but from a set it and forget it, pure theta, XLE for me.
Okay, Tim?
It's really
by the way, very quickly, the right to own contracts are really good too. Either one's in a really good environment for both of them. So.
Sure. Yeah. I think, both of these guys just nailed it right on the head for many different points. Number one, I loved the spreadsheet example that Matt did. And if you're out there watching, make sure that you grab a copy of those spreadsheets. The Theta one is the one that we're highlighting here today. You can grab them on the Trade Center. But I think what Mark just said is exactly where my last thought was as well, Emily. I'll just echo it. If you were telling me that you wanted to own, I think it would have been a different conversation. I would have been more open to leaning towards Devon because you still get a good number. You still get a really nice return with more, cushion in terms of less volatility built into the XLE. I like the XLE. I think it's an easy call between the two based on the premise that you said and based on the goals that you have.
Let me ask a question though. If it were not for earnings within the time period of the contract, would you have the same take on Devon versus XLE?
I would. If we don't have earnings, I'm going Devon.
I would probably right to own Devon. Can I make my argument?
Yes.
Very quickly. Very simply here, and I'll do the analysis very quickly. When you're writing to own, you want to, and this is my subjective philosophy here because the rules are based on delta. And when it comes to identifying support, there is some subjective nature to that, okay? But when I'm looking at Devon, I'd really like a support bounce here. And the simple reality is this. If you formed a dip on Devon, and I'm talking a deep dip down to the 50-day moving average, I would absolutely love that on the weekly chart. That would be a clean entry from a position style on a weekly chart. And so I do think Devon is in a scenario where you could write to own. I think XLE is in a scenario where you could write to own right now. If you're going to write to own, though, the one key metric versus writing is just you're selling a naked put.
You're selling the put.
That's all that means. So when you're writing that put option, when you're writing to own, you want to sell it slightly above support. When you're writing for pure theta, you want to sell it right under support. And so we identified $32 as that weekly channel on Devon. That's why we wanted to sell the 31. 32, and now it means 32 or 33 when it comes to writing to own. And so when I come down here, I look at the 32 versus the 33 contract. I don't want to sell at support because that means I'm in a test. I want to get above support, and that's just me. So I'm gonna do the 33 strike there. The 33 strike has a 16 delta. If we write to own, we get 68 cents on the credit. We got 68 cents on the credit. We're selling the 33 contract, which means we're going to have to put up $330. We get 68 cents on that credit. ATR ranges, all of that's going to be identical. So here's the right to own one. DVN, price 39 and change, 164. We're still working November. We're still working 38 days. Now the strike price we're selling here is now 33. It has a delta of 0.16. The net credit we are receiving, because we're going to take on a little bit of higher risk selling higher strike price, is $68 per contract. We're going to have to put up a rock solid $330 per contract. And so now what you look at is you're going to give up a little bit of the ATR buffer. You're writing a higher contract, right? But now look at your standard ROI. 16% ROI on the 30-day number if you don't own. If you do own, and the ROI's going to be fairly similar here, right? Because again, ROI takes into account cash flow divided by delta. That's why it's such a wonderful metric when you're identifying, all right, 3 different opportunities and you want to cross compare. And so it takes into account your delta. So you got a very similar type ROI from the right to own versus the right to versus, and again, right selling a naked put for ownership versus just pure theta. The right to own, though, this is a company that I think has big time momentum. And the most likely scenario, guys, is what here? Even with earnings, the most likely scenario is the strike price won't get hit.
Yeah, you'll just keep it
right.
Yeah.
So you're just going to keep the $68. But in the unlikely scenario where Devon does get blasted, we're looking at a key level of support, i.e. 32, and we're writing the 33 contract, which is saying, I'm willing to buy that bullish retracement on the weekly chart.
Mm-hmm.
And so I just wanted to showcase the different philosophical nature of the right to own versus the right to theta.
And I think for me,
listen,
and I love that.
And what Matt said there, and it's a key thing, and he taught me this a couple years ago in my naked put selling, and I actually incorporated it in. One thing that like the Cash Flow Vikings will see that I do, I always sell naked puts above support. I always sell naked puts above support. Because if you want to own, you want to pick up those extra credits. And so
do you want to, can I give you an example very quickly? I'm willing to bet anybody that wrote a $53 contract on Verizon probably regrets that at this point.
If they were just selling it to not own it and just like, I'm going to capture some credit because support is going to hold.
Mm-hmm. Yeah. And so you want to sell it above support to let support work for you. And it's just one of those ways at Tackle that we combine our technical skill set with our option strategies.
And I call it the sweet spot.
Yeah.
And the reason I call it the sweet spot is that you will get scenarios where you're put the shares, but support holds. And if support holds and you're put the shares, that is a really nice position to be in.
You cash flow, because if you are put, you get to keep your cash flow, and then you're getting at basically the price threshold where you expect price appreciation.
And you can have some price appreciation, and that's why I call it the sweet spot. And so if you're going to write to own, I mean, writing it a strike or two underneath support, like it just doesn't make any sense to me, because you're probably in a mess if support breaks and management one way or another, right?
Yeah.
So